There is no question that liquid trading positions far outweigh fixed positions. The difference is in a liquid position, your assets are easily convertible to a medium of exchange or some other form of tradable asset. The opposite to that is owning an asset such as real estate, which has a fixed position and is commonly termed dead capital. In my opinion, the healthiest position is to have capital that can be easily mobilized or converted to a medium of exchange or some other tradable position. I receive many messages where people cannot understand why it is that I am not a fan of fixed asset dead capital positions. People also ask why it is that I consider real estate to be debt. The reason is that it operates on a market price, on a supply-demand curve, is often purchased through a fractional lending institution such as a commercial bank, and upon sale is generally only convertible to a medium of exchange known as a fiat currency, or even better termed, a promissory debt note. This kind of position represents no wealth whatsoever, despite the fact that real estate appears to be going up in value. If you take the example of a Mars bar, which has increased nearly 3x in price through the quantitative eased COVID-19 period, most people would avoid buying the Mars bar. But if I were to take real estate and present the exact same scenario, for some reason people purchase the real estate. What people need to understand is that the value of a Mars bar and the value of real estate is impacted and affected by the exact same mechanism. That mechanism is nothing more and nothing less than the printing of currency and the expansion of something called the M2. And all that is the expansion of the currency supply with more dollars chasing fewer goods and services. This gives the impression that assets in the debt system are going up in value, but nothing could be further from the truth. The metric that people need to be looking at is the velocity curve. Is the currency really moving through the system? In a healthy velocity curve, a dollar would be exchanged about 6 times. Moments before the crash of Wall Street in the October of 1929, the United States was on a negative velocity curve, just like we are here in Australia. The way that the central banks counter this is by printing currency to make it look like the economy is buoyant. But the only problem with that is that the more currency that is added to the M2 devalues the entire currency pool, driving the price of goods and services up. But inflation is nothing more than the common man trying to buy goods and services with a debased currency. And by the way, the Australian dollar was debased by around about 18% in 2024. If you continue to save Australian dollars in the commercial bank, sure, you might get 5% interest on your deposits. But the problem is you have to factor in debasement, which puts you at close to minus 13% by year's end. At Beat the Reset, we are investors in monetary commodities. The difference between a monetary commodity and a fiat currency is that the commodity can move substantially in counterweight to a collapsing value in a currency. For example, in 2024, gold moved 40% to the upside, whereas the Australian dollar moved 18% to the downside. That is a 58% variable. There is a very strong reason why we advocate for gold and silver and Bitcoin, which had 120 to 130% upside in 2024. For those looking to diversify into physical gold, silver and Bitcoin, I personally believe that our time is running out. There is no question in my mind that the commercial banks in the Western world are beginning something called a bail-in process. This is where the commercial banks prevent the common man from withdrawing funds either through policy or through an inability to access an account through freezing or suspension. This is why decentralization and autonomy is critical through this period. Physical gold, physical silver, and Bitcoin give you this kind of autonomy. In addition, they give you long-term wealth preservation. And please don't write to me telling me that you can't buy bread and milk from your local grocery or supermarket with gold and silver. We know that. That is not the mechanism of gold and silver. Commodities are a store of value over time, period. But if you are looking for an alternative payment system, well, Bitcoin already provides that. Bitcoin is not only a store of value over time, but it can be converted to stablecoin and to virtually any currency in an instant. As a monetary researcher, these are the assets that will get you and your family home. These are the assets that are a store of value over time, and these are the assets that will provide the liquidity and the value that you are looking for. So please remember, we are heading into a tokenized world where your entire life will be traded on a blockchain. If you're okay with that, continue doing exactly what you're doing. But if you are looking to protect yourself, your neighbors, your friends, and your family, then you need to consider moving to a decentralized zero counterparty risk asset position, and preferably an asset class that has rapid liquidity. Make good choices.